There's a reward waiting inside almost everything you buy. Points on the coffee, cash back on the groceries, miles on the flight you were going to take anyway, a match on the money you set aside for retirement, a discount if you sign up, a bonus if you refer a friend, a free month if you promise not to cancel. Every swipe, every sign up, every purchase, something small is being dangled in front of you. Here's the obvious part. Companies use rewards to get you to do things. Offer a prize, change the behavior. Everyone knows that. It's not a secret. What's less obvious is who the reward is really built for, and it is almost never built for you. It's engineered backward from something someone else wants, and you respond to the reward that's actually in front of you, which is rarely the one you were told about. That's what this episode is about. Incentives. Not the polite idea that people respond to rewards, but the harder mechanism underneath it. That people optimize for the exact thing being measured and paid relentlessly, even when that turns out to be the opposite of what anyone intended. Learn to see the incentive underneath a system, and you stop taking anyone's stated reason at face value. You start asking one quieter question: what is this person actually being paid to do? And that answer will explain more of the world than any of the reasons people give out loud. Start with the clean version, the one that actually works. People respond to incentives. Raise the reward for something, and you get more of it. Raise the cost, and you get less. Tax cigarettes, people smoke less. Subsidize solar panels, and more roofs get them. Fine a factory for pollution, and the pollution drops. Offer a bonus for hitting a number, and people chase the number. This is one of the very few levers in all of economics that behaves reliably. You don't need to know what's in anyone's heart. You just need to know what pays. Push the lever, and behavior moves. And here's the quiet thing that separates it from a textbook fact. Once you actually see it, you can't unsee it, and you don't get to put it back down. The free shipping threshold priced $2 above your cart, so you add one more item to clear it. The subscription that's easier to keep paying than to cancel because someone made canceling a small chore on purpose. The credit card that literally pays you to spend money. None of these are accidents. Each one is a lever, calibrated, aimed at a specific behavior, usually yours. That's the capability you walk out of this episode holding. The world stops looking like a loose pile of offers and starts looking like a set of levers, every one of them wired to somebody. Now hold that model up against something real, because this is where it gets tested. In 1902, the French colonial administration in Hanoi had a rat problem. The city's brand new sewer system had turned into a kind of underground superhighway for them. So the administration did the textbook thing. It created an incentive. It put a bounty on rats, 1 cent for every rat tail turned in at the municipal office. Tails, not whole rats. Collecting corpses seemed like too much of a mess for the clerks to manage. Tails poured in, tens of thousands a day. On paper, the program was a triumph. And then health inspectors started noticing something strange around the city. Rats, alive and well, scurrying around, with no tails. People had worked out that a live, breeding rat was a renewable source of income. Why kill it? Snip the tail, release the rat, let it go, make more tails. Out in the countryside, the truly enterprising started farming rats, breeding them on purpose, for the bounty. The incentive was fewer rats. The behavior it actually purchased was more rats. The program was scrapped, and Hanoi was left with a larger rat population than it had before anyone offered a single penny. The administration thought it was paying for a result. It was actually paying for a number. And the number and the result had quietly come apart, the way an exploit opens up in a set of rules, a gap between what the designers meant to reward and what the rules literally reward. The people of Hanoi didn't do anything mysterious. They read the rule as written, found the gap, and worked it until it was patched. This has a name. Economists call it a perverse incentive, and there's a broader law sitting underneath it. Goodhart's law, after the British economist who spotted it in the 1970s while studying monetary policy. The popular version goes, when a measure becomes a target, it stops being a good measure. The rat tail was a perfectly good measure of dead rats, right up until it became the target, at which point it stopped measuring dead rats and started measuring how badly people wanted a penny. You don't need a colonial sewer to see it. Measure a school only by its test scores, and eventually you get schools that are very good at test scores and quietly worse at teaching. The lessons bend toward whatever the exam rewards, because that's the number on the wall. Measure a call center only by how fast it closes tickets, and you get tickets closed fast and problems that never actually get solved. The measure always starts out honest. It describes something real you care about. The trouble begins the instant you bolt a reward to it, because from that moment forward, people optimize the measure, not the thing the measure was standing in for. The map gets gamed, and the territory is left to fend for itself. Here's the part that should change how you read your own money. Anyone who's spent real time inside a well-built game knows this reflex without ever giving it a name. Hand players a reward structure, and they will not play the way the designers imagined. They play the way the rewards actually pay. They find the cheapest, fastest route to the payout, and they run it into the ground, right up until the designers rewrite the rules. Min-maxing. Optimize hard for exactly what's rewarded. Ignore whatever was merely intended. It isn't cheating. It's reading the system honestly and acting on what it really says instead of what it claims to say. And here's the thing, designers learn the hard way, and the rest of us mostly don't. This isn't a flaw in a few greedy players. It's what any large group of people does with any reward structure every single time. The more people you point a lever at, and the harder you point it, the more certain you can be that somebody will find the gap between what you meant and what you actually wrote. That's not cynicism. It's just how the machine behaves under load. People do this everywhere, with actual money on the line. In the early 2010s, one of the largest banks in America decided its growth engine would be cross-selling, getting each customer to hold more accounts. So it set aggressive sales targets and paid its people to hit them. And its people, being people, optimized for exactly what was being measured. Between roughly 2011 and 2016, Wells Fargo employees opened around 2 million accounts, checking, savings, credit cards, that customers had never asked for. Some existed only on paper. Internally, the staff even had a word for it: gaming. In 2016, the bank paid $185 million in fines, and thousands of employees lost their jobs. The target was more accounts per customer. The behavior that Target bought was fraud. Notice what nobody in that story had to be. Nobody had to be a villain. The individual employee facing an impossible quarterly target and a manager watching the number is not a cartoon crook. They're a person standing in front of a lever that was pointed at them, doing the thing the lever pays for. That's the uncomfortable core of it. You can predict what a system will produce far more reliably from its incentives than from the character of the people inside it. Change who's in the seats, keep the reward structure, and you get the same behavior all over again. Now, bring it all the way home, because this is not a story about faraway banks and century-old sewers. It's a story about who you are actually talking to whenever money is involved. The person selling you a financial product is responding to their incentive, not yours. An advisor paid by commission is being paid to move a product, so the product is what tends to get recommended, whether or not it's the best fit for the person sitting across the desk. This isn't a claim that everyone is dishonest. It's simpler and more durable than that. The lever is pointed at them, and levers work. Look at the piece of plastic in your own wallet. The credit card that pays you cash back is engineered around a reliable fact. People spend more on a card that rewards them than on one that doesn't, and a meaningful share of the people holding rewards cards carry a balance at interest. The points are the bait. The interest is the catch. The reward was never really a gift to you. It's the cost of getting you to run the behavior that pays the issuer, and for a lot of cardholders, the interest quietly swallows the rewards several times over. Even your own bonus at work is doing this to you from the inside, rewriting what you optimize for all day without ever asking your permission. Every one of these lands directly on your paycheck, your savings, or your debt, and every one of them snaps into focus the moment you stop asking what people say they want and start asking what they're being paid to do. So who comes out ahead here and who doesn't? The person who reads incentives has a small, unglamorous habit. Before they weigh what someone recommends, they ask how that someone gets paid. They read the fee before they listen to the pitch. They assume the free trial was designed around the friction of canceling, and they set the reminder. They treat every reward as a lever and quietly ask who's standing at the other end of it. They are rarely surprised because they saw the behavior coming straight out of the structure. The person who doesn't read incentives takes the stated reason at face value, takes the advice, takes the reward, takes the target as though it measures the thing it claims to, and they end up, quietly, repeatedly, without ever quite noticing the pattern, on the paying side of arrangements built by people who were reading the incentives better than they were. And this is the part worth being honest about. The gap between those two people isn't intelligence, and it isn't income. Plenty of high earners hand their whole financial life to whoever is friendliest across the desk and never once ask how that person gets paid. The gap is a single reflex, the habit of looking underneath the offer to the machinery that produced it. It costs nothing, it's available to anyone. And over a lifetime of fees and advice and rewards and minimum payments, it compounds into a very real difference in who keeps their money and who slowly hands it to a system that was reading them the entire time. This ties back to something from the last episode. Price, we said, is a signal. It carries real information about what people want. Incentives are the other half of that same machine, the lever that moves what people actually do. Put the two together, and you have the whole loop. Prices reveal desire, incentives shape action, and both of them are running whether or not anyone in the picture is paying attention. Step back and look at the full map, because you can read it now. Every system you move through runs on incentives, and most of them stay invisible until you go looking. The fee buried 3 layers down in the fund. The free checking account that quietly makes its money on overdrafts. The minimum payment printed on the statement sized so the balance shrinks about as slowly as the rules will allow. The single metric your manager watches, which silently decides what your entire team actually does all day. None of these announce themselves. All of them are levers, and every lever has a hand on the other end. And it runs at every scale, not just yours. The salesperson works to the commission. The executive works to the stock price the bonus is tied to. The whole company works to whatever number the market rewards this quarter. Stack those levers on top of each other, and you get behavior that looks baffling from the outside and perfectly logical the moment you can see what each layer is being paid for. Once you can read the incentive, you can predict the behavior, often before the people inside the system can predict it about themselves. You stop being surprised by outcomes that were baked in at the design stage, and you stop making the single most common mistake there is, assuming that when a system produces something absurd, someone somewhere must have blundered. Usually, no one blundered at all. The system did precisely what it was paid to do. It just wasn't paid to do the thing everyone assumed it was. If this is the kind of breakdown you want more of, financial systems stripped down to the mechanics actually running underneath them, subscribe to 8-bit economics. No hype, no predictions, no one telling you what to buy. Just the underlying code. If this episode changed how you'll read the next reward that gets dangled in front of you, hit like and drop a comment with one incentive you've caught running in your own life. The ones hiding in plain sight tend to be the best ones. This is episode 2 of 5 in our Economics 101 run, and the picture only gets sharper from here. Because by the time everyone sees it coming, the smart play is already over. So here's the question to carry out of this one. The next time something in your financial life looks irrational, a fee that makes no sense, advice that doesn't quite fit, a system that seems almost designed to work against you, don't ask what went wrong. Ask what was being rewarded. Because the behavior was never the glitch, it was the whole point.